Hello everyone and welcome to today's video. In today's video, I'll share my opinion with you as to why I don't trade or make investing decisions using analyst ratings alone. So, analysts provide the ratings from time to time on various stocks, but I do see some shortcomings of using analyst ratings only to make trading or investment decisions. So, in this particular video, I'm going to share my opinion with you around that. So this is what we'll cover today, that I'm going to share my opinion on what I think about analyst ratings and how we can actually effectively use them for trading and what pitfalls you must avoid. Before we proceed, a quick disclaimer that any information that I'm sharing with you in this video is only for entertainment purposes. It is not any kind of trading or investment advice. If you plan to trade or invest your money, please get in touch with a certified financial advisor. So let's get started. The first reason why I don't like using analyst ratings is that, in my opinion, what I have observed is that analyst ratings usually lag the price action. So, what do I mean by that? Uh, the one reason why you want to listen to anybody's advice regarding an investment or a trading opportunity is that you want to have advanced information with you based on somebody's analysis, right? So, if I were to tell you that the outlook for the semiconductor market looks very bleak in the upcoming future, and I give you concrete points as to why I feel that, then you can basically make a trading or an investment decision based on that. That's useful information. But mostly, what I have observed, and especially in 2022, it became very, very evident that when the markets are in a bullish phase, all analysts are basically giving you bullish recommendations and they keep upgrading stocks and they keep upgrading the target prices for the stocks. And when the market turned bearish, then on all analysts basically start giving you bearish recommendations. So they are essentially most of the times looking at the price action. So the price action already tells you that the market is bullish or bearish, and subsequently the analysts just fall in line and they start giving recommendations in line with the price action. But in my opinion, that kind of information is already very delayed. And if the market is already down by 10-15%, by the time the analysts start giving recommendations, it's more or less of not much use, in my opinion, because I don't need an analyst to tell me that the markets are bearish. I can myself see that the markets are down 10% or 15%. So it is evident that the markets are turning bearish, right? So, in my opinion, in my observation, most of the times, I'm not saying this happens all the time, but most of the times, the analyst ratings follow the actual price action in the market. So you'll see that a particular stock has already fallen by 20, 30, 40%. And this could be after earnings, this could be due to a macroeconomic environment or whatever reasons. And then a series of analysts will just come out and start downgrading that stock. So that kind of information, which follows the price action, is not very useful because all of us have access to our trading platforms and we can see the daily charts, we can see the real time live data, the price action. And so if analysts are going to make predictions based on the price action which has already happened in the past, that's not very useful. The real analysts would be able to provide these insights which are not already factored into the price. Okay, so if there is a risk for a particular or stock, then what I expect is the analyst to come out and say, when the entire market is bullish and the price action is not reflecting any bearishness, if an analyst can come out and say that no, there is a serious problem with this company and something can eventually go wrong, that is the kind of information which is useful. But I usually see that analyst ratings, they follow the price action rather than being the other way around. So you can't really effectively use these ratings for making trading or investment decisions. The second problem that I have seen with analyst ratings, now again, this is an observation and doesn't apply to all the ratings being given out, but you can actually observe this, that once, let's say, a certain analyst company, it comes out and it upgrades or downgrades a stock, you see a series of analysts coming out and giving you the same recommendation. That is, if a stock is being upgraded by one analyst company, uh, or a bank, or some analyst organization, you will see that everybody will come out and try to give a bullish rating. The only difference that I see is that they will set different price targets. So, for example, if some analysts go bearish on Netflix, then somebody will give a $300 price target, somebody will give a $250 price target. That will be the only variation. But you will see a herd of analysts actually giving bearish recommendation. Now, in my opinion, again, what I see is that on any day when shares of a company are being traded, you have buyers and sellers both. So there is a set of people who are willing to buy at that price because they believe the prices are going to go higher. And there is a set of people who are willing to sell at that price because they believe that the prices are not going to go higher, they will eventually go down. So they want to sell off whatever they hold in that stock. So when the actual people who are trading the stock, at any time, there are hundreds and thousands of people on both sides of the aisle, buyers as well as sellers. It is hard to believe why and how all analysts can be on the same side of the recommendation cycle. That means all analysts can go bullish or bearish in one go. And the second problem I see here is that when you, let's say for a company, you have five analysts saying that we are giving a buy recommendation, and five analysts give a sell recommendation, and both of them come up with their reasoning, then there's healthy competition. There's a lot of information out there logically because both groups are going to try and provide enough evidence as to why they feel that the stock is bullish or bearish. But if all 10 analysts basically give you a bullish recommendation or a bearish recommendation, or let's say 8 analysts out of 10 are giving you bullish and 2 are just not giving, they're giving a neutral recommendation, these analysts never compete with each other. So when they don't compete with each other, the onus on them to give any kind of evidence or information about why they feel strongly a bullish or a bearish recommendation for a stock, that never comes out. So this is really not good for the retail investors, because all you get to hear is that a group of people is bullish or bearish on a stock. You basically do not get too much of information as to what's the underlying reason why that recommendation is being made. So I don't like trading with the herd mentality. And if you've listened to any of the greatest investors, they will always say that in fact, following the herd mentality is the easiest way to lose your money, because the herd mentality sells at the bottoms. Why does the price keep falling? Because people are scared that they're going to lose even more money, they start selling. That's the actual time to buy. So if you know your analysis, if you know that a company is getting undervalued, instead of panicking and selling, you need to buy more of that stock. And when the company valuations go really high, when they are trading way above their intrinsic value, then the herd mentality is to keep buying because everybody wants to get into the action. Whereas the prudent advice at that time will be to start selling your shares and booking your profits, because slowly, if the price keeps going up, it's going to form a bubble which is going to eventually burst. So, in my observation, I feel that a lot of analyst ratings that come out, they come out late, which I discussed in the first point, once the price action has already taken place. And even then, you kind of get the same advice from a huge number of analysts, which is nothing but a herd mentality. And it is hard for me to believe that if 20 analysts are covering a stock, all of a sudden 18, 17, maybe even 15 analysts can be aligned on the stock in the very same way, because definitely a lot of contrarian investors exist, and there are always both sides to the story. Because if in the markets you have buyers and sellers at all times, then I believe that in the analyst community also you should have a fair balance, that at any point in time the balance can be like 60-40 or 70-30 even, but having a 95 to 5 balance, and that 5% also doesn't go against the herd. They're basically giving a neutral outlook. They don't go against the 95% of the analysts who may be bullish or bearish on a particular stock. So that's my second reason why I feel analyst ratings should not be used for trading or investment purposes. The third reason why I don't like using analyst ratings is because when I use my screeners, and I have I've published a lot of videos on the different screener settings that I use on the Finviz platform. I have screeners for options trading, for swing trading, for penny stocks trading. So a lot of different screeners are out there, and I sometimes find very undervalued companies which have extremely good cash flows, and there's no reason why you shouldn't be buying those companies. But those stocks are not the popular ones, and basically they don't get covered by any analysts, or you will have just one or two analysts covering the stock. And that I feel is the biggest loss that can happen to a retail investor if you look at analyst recommendations for making your trading or investment decisions. Because if the best companies out there, which give you the best valuation, which give you the best growth potential, are not even covered by the analyst ratings, then you're missing out on a huge universe of stocks which has a really great potential to give extremely good returns. And the reason this happens is very simple in my understanding. Uh, if you look at these analysts, they work for different investment banks. Like you have analysts working for Goldman Sachs, you have analysts working for Bank of America, and different companies which are in the business of providing these analysis and reporting to their clients. So think about it, that these guys make money by publishing their reports, by providing their analysis to their clients. So if you pick up some very popular stocks like Tesla, Google, Netflix, Meta, these are the stocks that most people want to invest in. They are really popular stocks, and everybody wants to be in on these stocks. They want to know what's going on with these companies. So if an analyst covers these stocks, it doesn't matter whether these companies are undervalued or they provide a good investment opportunity or not. But if an analyst covers these stocks and provides them to the clients, you will have a lot of clients, because a lot of people are interested in knowing the internal situation or the analysis or the buy or sell recommendation on these companies. But if you pick up very uh, I would say stocks which are not really popular, okay, if you pick up any of those stocks which may be excellent opportunities in terms of their fundamentals, in terms of their valuations, but if nobody's interested in those stocks, the analysts who cover those kind of stocks are not going to be able to sell the reports to too many people. So this is basically being run by analysts like a business. So you, as retail investors, also need to think that, are you getting, if you just restrict yourself to the list of stocks or the universe of stocks which the analysts are covering, are you basically getting exposure to all the possible investment opportunities out there? And the answer is a big no. And I figured this out because every time I run my scanners, I run the Finvest screeners, I get a huge list of stocks which have low valuations, which are fundamentally extremely good companies. There is almost no chance of these companies going bankrupt. They pay really good dividends. So everything is good about those companies, but I've never heard about those companies earlier, just because these companies are not the popular ones and they are not eventually covered by any of the analysts. So that's my third reason why I don't make trading or investment decisions solely based on analyst ratings. Now, if you've watched other videos on analyst ratings that I have created, I do propose one thing, that analysts, when they upgrade or downgrade stocks, that can have a short term effect on the price of the stock, because a lot of people actually use analyst ratings to make their trading or investment decisions. And so it becomes a self fulfilling prophecy, right? Because most people who cannot do their own analysis, they will rely on some expert, so called expert, the analyst, to give them a buy or a sell rating, and accordingly they will make their trading and investment decisions. But that does not imply that the stock is actually a buy or a sell, right? So what I try to do is that, if an analyst, if let's say I'm bullish on a stock and a lot of analyst ratings starts coming out which are giving a bearish call, that means opposite to what I feel, then I will not take a long position immediately. And the reason is because I understand that I am a retail investor, but these analysts, their reports go to hundreds and thousands of clients. Plus, these reports go to institutional investors. Plus, the retail investors also get to see these ratings, and a lot of people in the market will base their investment and trading decisions on these recommendations. So, I will wait for some time, let the prices fall further based on the analyst's bearish outlook, and when it kind of plateaus and forms a base, that is where I get in, because I do not want to capture that short term loss which can happen because of the analyst recommendations being opposite to what I feel about the stock. So I've just covered this particular point in brief here. I'll leave a link in the description to the video where I explain this in detail. This is what I wanted to cover about the analyst ratings. And just one thing, that on my channel, if you go to the community tab, the trades that I'm taking, I'm actually putting those trades on the community tab. Every time I open a new trade, I post it there, and every time I close that trade, I post it there. I usually post the trades within a couple of minutes, maximum a couple of hours that I have taken the trade, and I don't day trade. These are mostly swing trades which stay open for 20, 30 days, a week at least. Sometimes I get to close them early if my targets are met within a couple of days, but mostly these are swing trades, so there is no hurry. You can actually follow these trades even days later and they would still be active. So if you want to follow my trades and understand better, you can do that by visiting the community tab on my channel, and I hope that will be helpful. If you really find it helpful, please leave that information in the comment section. I would really love to hear if my actual trades help you learning this entire trading process, and if my experience is actually helping you become a better trader or a better investor. So again, thanks for your time. I'll catch you guys in the next video. If you like this video, please like the video and subscribe to the channel if you've not already done that. Share this with your family and friends, and I hope this particular information is useful to you. Do let me know what you think about using analyst ratings for trading, and if you've been doing that, was it successful for you, or how was your experience? Did you actually end up losing money or making money? So thanks for your time once again, and I'll catch you guys in the next video. Thank you.